Well, rising government bond yields has put a bit of pressure on the extreme equity valuations that we're seeing. But which market will be the first to crack? Will it be the bond market or the share market? Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 29th of October 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So like I said, government bond yields have been rising. They've actually been rising since the Federal Reserve cut interest rates in the middle of September, and it's been a spectacular rise. Overall, this could be the market suggesting that they're no longer as confident we're going to see a rapid series of Federal Reserve rate cuts from here. And they shouldn't be confident. Economic data has been extremely strong. Inflation data has been very, very sticky. And we've seen very high levels of US government spending. They're running ridiculous deficits. They're essentially printing money as fast as they can. And if you're a bond investor, you're going to want more US dollars when your bond matures because of how much they are printing money. Because you know that that dollar is going to be potentially worth a lot less than it is now. So bond investors are demanding much higher yields. Now, what does this mean for the share market? Well, if bond yields are rising, this means that share returns have to increase as well. And how do returns increase? Well, it means that prices come down. So as those bond yields have rallied, or bond yields have risen, I should say, it's been a bit of a dampener on share prices. Share prices are holding up fairly well, given what bond yields have done. But I don't think that's a guarantee moving forwards. Valuations are very, very, very stretched at the moment. And given what bond yields have done, we could see valuations be revised a bit lower. All right, we will touch on some of the events this week that could change that dynamic a bit. But let's first start with company earnings. This week is probably the biggest week of the year, at least the biggest week of this reporting season for US company earnings. We've got Microsoft, we've got Amazon, Apple, we've got Google or Alphabet, we've got Facebook reporting earnings. The first of these will be Google's report tonight, and then we've got Microsoft and Facebook tomorrow night. These companies make up a huge proportion of the global share market. And so whatever they do, global indices are likely to follow. It's expected to be a pretty strong season. It has been a very strong season so far. And if these companies, these 5 or 6 companies report strong results, I suspect that could be a bit of a bullish driver behind global markets, even in the face of, like I said, the rising government bond yields. It'll be very interesting to see what they do announce, and I suspect a lot of it is also going to come down to their forward guidance and what they announce for their plans moving forwards. It'll also be quite interesting to see what they announce with regards to their AI spending and their AI targets. Obviously, huge amounts of AI spending has been committed to by these companies, and that's going to continue to be the case moving forwards. But I'm not super convinced that investors will be as happy to reward those commitments as they have been so far this year. But regardless, we will have to keep an eye on that, on those announcements. For Australia, we've also got company earnings reporting coming up. We've got Macquarie Group, a large bank, reporting on Friday, and then we've got ANZ, NAB, and Westpac reporting next week, or perhaps some of them the week after. This is a pretty major bank reporting period for us, and our bank shares are currently the most expensive banks on earth. There is potentially room for disappointment, and look, there are a lot of bank naysayers, so there may be a bit of room for a surprise to the upside as well with these reports across the next fortnight. So if you are looking at our own market, you do have to consider it in the context of these banks reporting as well. We will also get a trading update from CBA over the next couple of weeks as well. The other major thing for this week is there is going to be a plethora of economic data, both in the US and in Australia. And this will have big ramifications for what bond yields do from here. On tomorrow around 11:30 Eastern Time in Australia, we're going to see Australian inflation data, CPI data. And this data will basically decide, I believe, whether or not we're going to see an RBA rate cut this year. If the data comes in as expected or stronger than expected, I suspect we won't see an RBA rate cut this year. We'll see bond yields remain high. It'll be a huge dampener on the equity market. However, If we do see a surprise to the downside on inflation, that does open the door for a 2024 RBA rate cut. It also, I would suggest, we'll see bond yields come right back off, and that could allow further upside for share prices. I will just caveat that by saying that, Australian and also US economic data has been much stronger than expected over the past few months. And so, a surprisingly low inflation number is probably not my expectation for tomorrow's CPI growth. We're also going to see a huge amount of US economic data this week, and it's going to be very important data. We've got US third quarter GDP data being reported tomorrow night, and economic growth is expected to remain extremely strong. And that's despite, the very, very high interest rates. And why shouldn't US economic data be very strong? Their government is printing money as fast as it can. They're running huge amounts of deficits, huge amounts of government spending. When the US government runs a deficit, that's a huge net addition to GDP, and it's making up for a lot of their GDP growth. So I think it will be difficult for their economy to slow its growth in the face of those huge US government deficits. While that may sound very positive, it means that bond yields are likely to remain high as well. It means that the interest rate cut timetable may have to be pushed out further. Like I said at the start, if you're a bond investor and the government is printing money as fast as it can, you're going to want a higher yield. You're not going to be comfortable with a lower yield because you know that the government might, essentially make your dollar worth a lot less by printing a whole amount of extra dollars. And just on that, I have read some statistics that over the last 4 years, about 3/4 of US dollars were created in the last 4 years. So, like I said, if you're a bond investor, you're going to want a higher yield. The other important data release for the US this week will be PCE price data. That's going to come on Thursday night, Australian time. The PCE is the Fed's chosen measure of inflation. And, if this data point doesn't come in lower than expected, I suspect we'll see bond yields remain fairly elevated. And I suspect, again, we could see a bit of downwards pressure on share prices. So that will be a very, very important reading as well this week. It is the Fed's chosen measure of inflation. Markets do want to see inflation continue to slow from here. And everyone will be watching that event closely. And I suspect it's going to decide, who wins between the bond and the share market. Finally, we've got the US election. It's actually going to be next week on the 5th of November, but we will be sort of not recording a video on Tuesday. So our next video is going to come on Wednesday, probably after we know the results of that election. Historically, US presidential elections are bullish times for share markets. Markets have almost universally rallied after the US presidential election. However, we do have a fairly unique election this time around. Betting markets have got their, most probable candidate, but I would suggest that the election is a lot closer than the betting markets or the betting odds would suggest. So I think it could go either way. I'm not sure what the market's response to the outcome will be. I suspect there's a chance we see bond yields keep pushing up afterwards, regardless of who wins. And that might mean that, the traditional post-election rally might be a bit more subdued this time around. As I mentioned, our next video will come after we probably know the result of the election. So tune in next week and we'll go through it all together. So let's have a quick look at the charts for this week, guys. This is the ASX, the XJO, the 200 largest listed Australian companies. And we can see that after breaking through the uptrend line last week, our market's not done an awful lot. We've maybe found a bit of support around 8,200, but we've struggled to get it back above some potential resistance at 8,280. That's the level I'm watching to the upside. That was our previous all-time high, and we'd have to get back above that level before we look like challenging our recent all-time high right around 8,380. So if we do break 8,280, I think we will go back to the all-time high. And like I said, to the downside, we've recently held 8,200 as support. If that breaks, I'm looking at 8,150 and 8,100. Whether or not we break higher or lower from here, I believe is going to come down to what US markets do. So let's have a quick look at the US charts for this week. And this is the US S&P 500, their largest and most broad-based share market index. They also broke their medium-term uptrend line over the past week, and they also seem to be consolidating in a fairly tight sideways range. They haven't seen quite as much selling as we have, and I suspect their market has sort of so far been disregarding those higher bond yields, but it won't disregard them forever. So like I said earlier, I think this week will be the week that either the bond market or the share market blinks. For their market, from a technical perspective, they're holding support at the previous all-time high, 57.70. If that breaks, we're going to see a move back towards 56.50, somewhere around there. We could see further selling even beyond that. To the upside, their all-time high resistance, 58.70. We'd need to see that break before further upwards movement looks likely. So at the moment, they're also consolidating inside this very tight sideways range, about 100 points. We are going to have quite a few major events, quite a few large company earnings reports. We're going to see a presidential election over the next week. So there's an awful lot going on, and I suspect one or multiple of those events will trigger the next directional move that we'll see for share markets. If you guys know which direction it's going to break, let us know in the comments below. Click like, click subscribe, and we'll see you next time.